Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
Palantir Q4 preview set to win the AI bifurcation trade. This article was written by Amrita Roy. Summary: Palantir remains fundamentally strong, but 2026 could prove to be more challenging after 3 consecutive years of 100% plus gains, with upside capped at 21% with a $199 price target. Palantir continues to outperform the SaaS complex despite the recent meltdown in the sector, benefiting from its positioning with AIP and robust U.S. commercial growth. While Palantir will likely beat its Q4 revenue estimate, marking the 10th consecutive quarter of acceleration, its EPS growth is set to decelerate, warranting appropriate risk management. OpenAI's funding risks and a richly valued S&P 500 add macro uncertainty, which could lead to further pressures on Palantir's earnings multiple in 2026. Hi, I am Amrita Roy, and I write primarily on software stocks. I work 7 years in tech in SF, and I take a fundamentally driven approach to investing, with a focus on macroeconomy. Introduction and investment thesis. After clocking in plus 167%, plus 340%, and plus 135% gains over 2023, 2024, and 2025, respectively, is Palantir PLTR stock headed for another 100% plus year in 2026? That's the question on everyone's mind. So let me get straight to the point. Palantir stock has not been able to create a new high since the time of my last writing, underperforming the S&P 500. While it has withstood the SaaS apocalypse much better than several names that have seen their market caps decimated in 2026 so far, Palantir stock still remains priced to perfection. It is likely that Palantir will once again beat its Q4 revenue estimate, marking a 10th consecutive quarter of revenue acceleration, when it reports its Q4 FY25 earnings on 02/02. However, the growth rate in its earnings per share is expected to start slowing down. This is at a time when overall analysts' estimates for earnings per share growth for the S&P 500 are optimistic, while the index is trading over its 5- and 10-year price-to-earnings multiple, not to mention that there is no room for any disappointment from OpenAI, which can otherwise cause a short-term meltdown in the AI trade. What I want to make clear is that at a fundamental level, Palantir's bullish thesis still remains intact. As we heard from TSMC's TSM latest earnings, the demand signals in the AI build-out are strong, leading the company to ramp up their capex, while the current supercycle in memory just points to the explosion in demand for inference workloads. This all bodes extremely well for Palantir, where its AIP, artificial intelligence platform, plays a fundamental role in monetizing inference workloads by taking real-time data across systems and turning it into actionable simulations across business cases. However, at the moment, I don't expect Palantir to achieve 100% plus gains like the previous 3 years. My current price target of $199 per share still suggests an upside of 21% from current levels. So, while existing investors can continue to hold their shares, it is also important to keep stop losses for risk management purposes. A brief recap of Q3 FY25. When Palantir reported their Q3 FY25 earnings, it marked the 9th consecutive quarter of revenue acceleration, with revenue growing 1,300 basis points higher than management's expectations at 63% year-over-year, while operating margins came in 500 basis points above estimates at 51%. This, I claimed, was driven by the acceleration in both the company's commercial and government segment, which grew 73% and 55% year-over-year, respectively, with particular strength in U.S. commercial revenue, which grew 121% year-over-year to $397 million, contributing over a third of Palantir's total revenues. During the quarter, we saw a record number of deals closed worth over $1 million plus, $5 million plus, and $10 million plus, while U.S. commercial total contract value has expanded 212% year-over-year to $843 million during the quarter, driven both by the expansion of existing customers and the acquisition of new customers. In my previous post, I had discussed that NVIDIA, and Palantir's strategic partnership to integrate NVIDIA's accelerated computing, CUDA-X libraries, and Nemotron OpenAI models into Palantir's ontology framework would enable advanced data processing, automation, and context-aware AI agents across various operating environments, especially as we are in the early phases of an inference boom, where enterprises start to deploy agentic AI applications at scale. This, I argued, could lead to the next leg higher in the stock price. However, that has not yet materialized since the time of my last writing, amid a severe SaaS meltdown, despite the overall S&P 500 moving higher. In the meantime, Palantir has introduced several upgrades to its AIP and ontology framework since the start of the year, where it has launched AI FDEs, AI forward deploy engineers, that can autonomously handle complex engineering tasks through conversational prompts, along with a new orchestration tool called AI HiveMind to help agents coordinate and solve complex problems across use cases. Plus, in January, Palantir also introduced Ontology MCP, Model Context Protocol, to allow developers to connect external agents directly to Palantir's ontology. How Palantir fits in the current AI bifurcation trade. One of the reasons why Palantir has underperformed the S&P 500 since the time of my last writing could be tied to the utter apocalypse that the entire SaaS complex has faced since the start of the year. As I outlined in my Atlassian post, the latest round of sell-off has been triggered by Anthropic's launch of its Claude Cowork on January 12, 2026. This is what I wrote in the post that captures why investors have abandoned the SaaS trade, resulting in massive repricing of stocks in the complex, despite no meaningful downward revisions in forward revenue and earnings growth estimates. Essentially, Claude Cowork is an autonomous AI agent that can manage files, generate documents from notes, create spreadsheets, and organize workflows without human intervention. This resulted in investor concern that with AI agents handling a wide range of tasks autonomously, companies will now need fewer human workers and therefore fewer software licenses, which threatens the traditional seat-based predictable ARR model of software companies. However, what is important to note is that despite the sheer destruction of market value in the SaaS complex, with stocks like Atlassian, Team, ServiceNow, Now, Monday.com, MNDY, HubSpot, HUBS, and more down negative 10% plus year-to-date, Palantir has comparatively fared better on a year-to-date basis. As Shay Ballur, chief market strategist at Futurum Equities, pointed out in his Something is Changing in Software post on X, there are 3 buckets in software, where the third category is where markets are being the most ruthless. First, companies where AI increases the importance of what they do because security, networking, and enforcement become more critical as agents proliferate and as attack surfaces explode. Second, platforms that can plausibly become the workflow substrate for agents, meaning the place where work gets routed, audited, permissioned, and executed, which could actually become more important, not less, because enterprises will need orchestration as complexity rises. Third, the long tail of application SaaS, where the product is basically a set of screens on top of someone else's data, and the value can be delivered by an agent without paying for the seat. This is precisely what I had explained in my MongoDB post in December, where companies like MongoDB, MDB, and Palantir belong in Shay Ballur's second bucket, and are faring better than the overall SaaS complex, as they have positioned themselves as essential AI infrastructure plays rather than AI-disruptable software applications, while simultaneously benefiting from consumption-based business models. In the meantime, the Q4 earnings season has begun, where we got indications of a strong demand signal from TSMC, which not only ramped up its CapEx guidance for 2026, but also guided for its gross margins to continue expanding, while their leading-edge nodes make up a growing portion of total revenue, 77% to be precise. This is what TSMC's CEO said during the earnings call that underlined his confidence in the strength of the AI build-out. I spent a lot of time in the last 3-4 months talking to my customers and end customers' customer. I want to make sure that my customers' demand are real. I'm quite satisfied with the answer. They showed me the evidence that the AI really helped their business. Plus, what is also interesting to note in the current AI bifurcation trade is the exceptional strength we are witnessing in the stock price actions in the memory and equipment manufacturing sector. This includes stocks such as Micron, MU, SanDisk SNDK, Western Digital WDC, Seagate STX, Applied Materials MAT, Lam Research LRCX, and some more. While the underlying reason for the exceptional performance in the above stocks is tied to the surge in DRAM prices driven by an overwhelming demand for memory from hyperscalers, along with memory manufacturers prioritizing the next generation HBM4, creating a ripple effect through the AI infrastructure stack, one thing is clear. That is, the explosive demand for inference, which is expected to make up over 40% of data center demand by 2030 and will be growing at a compound annual growth rate of 35% over the next 5 years, outpacing the demand for AI training, as can be seen below. Why does this matter for Palantir? Well, as we see the demand of AI workloads shift from training to the inference phase, we need to solve for deployment and monetization. Like I said earlier, this is where AIP's AI native control layer embeds itself across the entire operating stack of a company, takes real-time data across systems, and turns it into actionable simulations across business cases, generating measurable ROI. As we have seen since the start of Q1 FY25, Palantir management has revised their full-year FY25 revenue higher by over 12%, driven particularly by their U.S. commercial revenue, which has been revised higher by 22% and is now expected to grow 104% year over year. You can also see the momentum in upward revisions and forward consensus revenue estimates below. Price to perfection, while OpenAI remains an open threat. However, in all of this, the question remains whether Palantir stock is all too priced for perfection. The company is scheduled to report its Q4 FY25 earnings on February 2nd, where consensus estimates point to a revenue growth of 62.04%, with earnings per share growing at 64% year over year. To that, it is quite likely that Palantir may once again beat its revenue estimate, marking the 10th consecutive quarter of revenue acceleration. This is based on its past record of revenue beats, which has averaged 6% over the past 4 quarters. However, when looking at the projected earnings per share growth, we can see that the rate of growth is expected to decelerate from here onwards, as can be seen below. Meanwhile, when we look at overall market conditions, analysts are very optimistic about the S&P 500's growth rate of 2026 earnings per share, where they expect it to accelerate to 14% plus, compared to a projected 11% plus for 2025, with a bottom-up 2026 year-end price target for the S&P 500 at 7,968.78. I would also like to point out that the S&P 500 is also quite expensive on a forward PE basis. At the moment, the forward 12-month PE ratio for the S&P 500 is 21.8, which is above the 5-year average 20.0 and above the 10-year average 18.7. In all of this, the risk of OpenAI remains undeniable, especially with the spree of circular financing deals worth over $1.4 trillion that it engaged in. As I pointed out in my Oracle post this month, OpenAI's bills start to come due in 2H26, as per Citi's estimates, while HSBC projects that the ChatGPT maker will need to raise an additional $207 billion by 2030 to sustain operations. While OpenAI expects to grow their revenues from an estimated $20 billion in 2025 to over $100 billion in 2029, a feat that no other company has ever been able to achieve, it is also worth noting that any hint of a potential failure to reach those targets will create massive risks of not finding enough funding, which could create ripple effects in the AI ecosystem. My valuation and conclusions. Since the time of my previous writing, there has not been any fundamental change in forward revenue or earnings expectations. As a result, keeping the same underlying assumptions as before and attaching a forward PE ratio of 115, same as before, which is roughly 6x that of the average S&P 500, given that its earnings are expected to grow at a compound annual growth rate of 50% between FY25 and FY27, I arrive at a price target of $199.8 per share. Taking the forward consensus estimates for revenue growth into account, and assuming that Palantir would be able to anchor its gross margins at 82%, while normalizing the growth rate of its operating expenses from 20% in FY25 to 7% in the following years, we arrive at a total non-GAAP operating income of $5.2 billion by FY27. This represents a margin expansion of roughly 1,300 basis points to 62% from current projected levels of FY25, as it sees expanding operating leverage from deepening AIP adoption across its commercial business across use cases, along with continued strength in its government business. My price target of $199.8 per share is also more or less in line with the average price target on Wall Street at $190 per share, with the highest price target at $255 per share. The way I see it, Palantir stock has clocked in gains of 167%, 340%, and 135% in 2023, 2024, and 2025, respectively. However, 2026 may not be as straightforward, with my current price target of $199 per share targeting a potential upside of 21% from current levels. Therefore, while existing long-term investors can continue to hold at current levels, as the long-term bullish thesis still remains intact, new investors can choose to initiate a small position with a potential stop loss should the stock breach its 50-week high at $147 per share. Rita Roy.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.